All right, let's just jump right in. The outlook for 2026 is shaping up to be, well, a total paradox. We're seeing this incredible optimism from Wall Street, but at the very same time, we're getting these serious warnings about a global slowdown. So, what's the real story here? Let's unpack this gamble. So, let's start with the good news, the bull case. It really boils down to this one number, 7,500. That's the S&P 500 target Wall Street is throwing around. And what's fueling all this excitement? You guessed it, it's the AI boom. We're talking a massive wave of spending that's expected to just keep juicing company profits. But hold on. At the exact same time, you've got big players like JP Morgan putting this number out there, a 35% chance of a recession. I mean, how is that even possible? A massive stock market boom and a 1 in 3 chance of a global recession? It just doesn't add up. Or does it? Okay, let's look at the bull case, the AI boom. First, let's dive into why everyone's so optimistic. And really, it all comes down to one thing. Here's the thinking, summed up perfectly by Hussein Malik at JP Morgan. The idea is that this AI train just isn't stopping. It's a relentless wave of investment that's boosting productivity, opening up whole new markets, basically propping up the entire economy, even with all the other stuff going on. And this isn't just a tech bubble either. The numbers for the wider U.S. economy actually look pretty solid. We're looking at a forecast of 2.3% real GDP growth. That's pretty darn resilient, especially with inflation expected to cool down a bit. It seems like policymakers might be creating a more supportive environment. Okay, before we get to the other side of this coin, the risky part, we've got to do the usual disclaimer. Just a reminder, this is all for informational purposes. It's based on expert analysis, but it is absolutely not investment advice. You know the drill. Past performance is no guarantee of future results. All right, now for the bear case, global headwinds. For every sunny forecast, there's a pretty big storm cloud gathering. So let's take a look at what could go wrong. So risk number one is inflation. It just might not go away as quickly as everyone hopes. Take a look at the 10-year Treasury forecast. Yields are expected to stay high. And you know what that means, right? It means money isn't cheap. Borrowing costs stay up, which puts the brakes on the economy and basically ties the hands of central banks. And JP Morgan strategists are spelling it out pretty clearly. There's a whole list of things to worry about. A genuine macro slowdown, not just a little blip. Inflation getting sticky enough to force a hawkish pivot. What if people get tired of the AI hype? Then you've got ongoing geopolitical conflicts and a labor market that's just getting tired. And if you zoom out and look at the whole world, you can really see the cracks forming. Yeah, the US is holding up, but look at the Eurozone. Growth is projected to be incredibly sluggish. They're still getting hammered by all these geopolitical shocks. So let's come back to this number, 35%. This is the whole point. It's not just a number they pulled out of a hat. It's a calculated risk that's backed up by all these powerful, very real headwinds we just talked about. Look, if you're getting value out of this and it's helping you cut through the noise, do me a quick favor and hit that subscribe button. We drop explainers like this all the time to help you make sense of it all. Next up, a polarized world. So, how can both things be true? How can the bulls and the bears both have such strong arguments? Well, it's because the economy itself is completely split in two. You'll hear experts call this a K-shaped economy. And it's a perfect description, really. Think about the letter K. You've got one arm shooting straight up and the other arm sloping right down. That's our economy. Some parts are absolutely booming, while other parts are in a serious decline. It's wild. Strength and weakness literally happening at the same time. And this just lays it out perfectly. Look at the booming side. AI, tech, aerospace, and defense. All that capital expenditure is on fire. But then look at the other side, the fatigued side. The labor market is tired, people are spending less, and global trade is slowing down. It's a tale of two economies in one. Okay, Section 4, navigating the divide. This is the big question, right? For any investor, for anyone just trying to understand what's happening, what do you do in a world that's being pulled in two different directions? I mean, seriously, how do you position your portfolio when you've got this massive AI boom happening at the same time as this huge recession risk? It feels like walking a tightrope. You can't just go all in on one side or the other. Well, analysts at Morgan Stanley have actually put together a 3-part strategy for this exact problem. It's designed to help you navigate this divide, to handle the risks while still grabbing the opportunities. So let's walk through it. First up, focus on quality. Simple as that. With all the risks of a slowdown and a tired labor market, you want to look for companies that are built like tanks. We're talking strong balance sheets, reliable profits, the kinds of businesses that can do well even if the economy stumbles. Sectors like financials, healthcare, defense, and energy are where people are looking. Okay, number 2, consider real assets. Remember that nagging risk of sticky inflation, the one that could keep interest rates high? This is your hedge. Real assets are things that tend to hold their value when inflation is up. Think gold or maybe energy infrastructure. They can act like a shield for your portfolio. And just to give you an idea of how seriously some people are taking this, check out JP Morgan's 2026 forecast for gold, over $4,700 an ounce. That's a huge number. It really shows you how much potential they see in gold as a safe place to be. And finally, step 3, explore emerging markets. Look, the US AI boom has been incredible, but what if it runs out of gas? It makes sense to look for opportunities outside the US. While American stocks are pretty pricey, a lot of equities in faster-growing emerging economies are still trading at a relative discount. It's a way to find growth from a completely different source. So here's the bottom line. The secret to 2026 isn't about betting on the boom or hedging against the bust. It's about building a portfolio that's resilient enough to handle both. It's about navigating that K-shaped divide. Now, to really understand how this AI boom is changing everything, you've got to see how it's playing out in specific industries. Click right here to watch our next explainer on the AI revolution in healthcare.